Hi, my name is Philippe Crook from Realty One Group here in Las Vegas, Nevada, and I am sitting with Peyton Powers with Sierra Pacific Mortgage. He's a mortgage lender that I've worked with since 2008. I send most of my clients to him, so I wanted to get him on film and ask him a bunch of questions a lot of clients are asking me right now. So I'll start right away.
Yes.
What's going on with the mortgage market?
Very volatile. All right, so administration is making some changes, or even rumoring of changes, to where Wall Street is really running with those. So you've noticed Wall Street is doing very well lately.
Yeah.
So typically when Wall Street does well, the bond market does poorly. So this is crash course economics here. So when you take money out of the bond market to put into the stock market, bond market typically drops, which actually has a reverse effect on rates, and rates start to go up. So that is what we've been seeing since the election, just by rumors of what might come.
So rates have already increased since the election.
Drastically, actually, yes.
Okay. And Feds are anticipating that rates are going to continue to rise.
Correct.
Okay.
That's
So
the prediction.
if you're trying to refinance your home, or if you're looking to purchase a home and you want to get a low interest rate, it's really important that you do that sooner than later, just so you can capitalize on the best
Correct.
interest rates.
Rates are still, I'm not trying to scare you, rates are still very low. It's just not as low as what they were this time last year.
Yes, historically they are
Still a very good time.
very, very low. But we always try to save you as much money as possible, and that's one of the reasons why I like to use Peyton. He looks at every different option and gives you the best scenario for your specific situation. Can you talk to me a little bit about the different loan programs and what's available?
Yeah, absolutely. What we see here, at least in Clark County, predominantly are FHA, conventional, and VA. Those are the three main ones we look at.
Mm-hmm.
FHA is going to be more credit lenient. It's geared towards first-time home buyers, but it is not limited to first-time home buyers. So the rule is you're not allowed to have more than one FHA loan out at a time. So if you currently have an FHA and you're selling, you're welcome to do another one. It just depends on what your long-term goal is. So again, like you said, I like to look at everybody's scenario and kind of give them the options and see what's the best use of your money. FHA is going to be more credit lenient. So if you have some hits on your credit, you have some derogatory stuff on there, FHA is always a good route to go. It's not as...
Like a collection or...
Correct, yeah. So if your score is low for any reason, FHA is a little bit more lenient to that, to where it's not going to be reflected in the rate as much, whereas conventional is very credit driven. So FHA allows 3.5% down.
Mm-hmm.
Mortgage insurance is structured in two different ways. They do an upfront that's rolled into the loan, as well as a monthly. The big thing for FHA is mortgage insurance is on there for the life of the loan for most borrowers, meaning you don't ever remove the mortgage insurance unless you refinance into conventional or you sell the property, obviously.
Okay, so if you're only going to be there, a short amount of time, doesn't really matter.
Correct. Yeah, 5 to 10 years. If you plan on owning a home for 5 to 10 years, FHA is a very good option still, depending on your credit profile and your down payment scenario. So again, my job is to look at the options and see which is the best use of your money.
Okay. And then conventional wise?
Conventional, we have a lot of different routes to go as well with that. You have as little as 3% down, which a lot of lenders don't have. Yeah, 3% down. That one is geared towards first-time home buyers.
Okay.
And then 5% down is a very common one as well. Then you also have, every 5% down, there's different rules for the mortgage insurance and credit as well.
So you still have mortgage insurance?
Correct.
Until you put at least 20% down?
Correct. So that's the beauty of conventional is, again, it's everybody's scenario is different, but with conventional, if you put 5%, 10%, 15%, they're all structured. There's a table to where the more you put down, the less percentage of mortgage insurance you have.
Okay.
And it's also combined with your credit profile.
Okay.
So everybody's different. My job is, again, present you the options. We actually have ways to roll in the mortgage insurance into the rate itself. So again, depending on your income level, sometimes the mortgage insurance is tax deductible, like interest, at least with the current tax code. That could change.
Yeah.
But you can hide it into the rate, which a lot of people say there's no mortgage insurance, but it is just really hidden into the rate.
Okay.
So you can have a little bit more interest you claim. So it just depends on everybody's income level on that. And again, my job is to help present you the options.
Okay. And what about for our veterans?
VA is an amazing loan, my favorite to work with. VA is very protective of the veterans, so they allow you to do 0 down with no mortgage insurance.
That's great.
Beautiful loan. The thing to keep in mind is funding fees that the VA charges. So they do charge a set funding fee that you roll into the loan. So you basically do 0 down, and your loan amount is a little higher than what you're purchasing because they roll into that funding fee.
But if you're very conscious about your cash and you want to keep your cash liquid, then that would be a good option. If
Absolutely.
You're
There's no
right?
mortgage insurance. It's a really powerful loan. Rates are typically on the lower side, very similar to what an FHA rate would look like.
Okay.
It's also credit lenient like FHA as well. So if you have some lower FICO score, some dings in your credit, you're not going to be hitting the rate as much as you would like for conventional.
Okay. Now talk to me about clients are always nervous about getting their credit pulled.
Yes.
So tell me a little bit about what that entails. And
for mortgage inquiries, it's not as scary as everybody makes it out to be. Mortgage inquiries are what's called a soft inquiry. So you're not going to be dinged as hard as you would, or at all most of the time, as you would for what's called a hard inquiry. A hard inquiry is when you apply for a credit card
or a car.
Or a car, exactly. So what happens is you can actually accumulate debt that day you apply. So you can get a credit card and go max it out right away.
Mm-hmm.
You can go apply for a car and drive off the lot with the car. So you accumulate debt right away, or you have the potential to accumulate debt right away.
Mm-hmm.
Mortgage inquiries is not the same. You're not going to apply and get a mortgage that same day. There's laws, there's legal time limits that have to wait. So they know that you can apply for a mortgage and not get a new account for months later.
Right.
So they don't ding your credit like they do for hard inquiry.
And what about those buyers who are wanting to do to purchase a property within 6 months, and they're nervous, they don't want to get pre-approved now?
Let's take a look. Yeah, absolutely. The best thing to do is look to make sure we don't have anything we need to address. We don't like surprises when we're trying to close a loan. So credit it's like a wound. So if there's something on there, we need to make it heal and let it time to heal. So we need to address it and work to fix it.
And there's been a lot of times where I've shown property to a buyer, and then something popped up on their credit report, like a medical collection.
Happens
or
a lot.
And it takes some time to remove something from a credit report. So I think it's always really important to get it pre-approved ahead of time. That way you know exactly what you're getting into before, and if you have to address any issues, you have some time to
Exactly,
do that, right?
absolutely. And credit reports are good for 90 days. So,
Okay.
And again, if we need to pull another one, it shouldn't affect your score, if at all.
Okay. How does someone get pre-approved if they want to get refinanced or pre-approved with you?
Very easy. Pre-qualifications are actually done. For me, I do all my work up front. So I like to collect everything and then work on the pre-qualification. So I like to get your basic income documentations, which would be, for me, the last 2 years W-2s, your last 3 consecutive pay stubs, and your last month's bank statement. I like all pages of your bank statement. But those are the minimum items I need. So
Say that one more time?
yeah. Last 2 years W-2s,
Okay.
most 3 consecutive pay stubs, and then your most recent month's bank statement.
Okay.
So once I get those, I can determine if we need to collect anything else to work on the pre-qualification.
Okay.
But sometimes those items are all I need to work on the pre-qualification itself to at least get them shopping for a home.
Perfect. Okay, and then how would they get a hold of you?
Yeah, very easy to get a hold of. Phone 702-938-7558, or my website, it's just www.peytonpowers.com, and that's Peyton powers.com, or email peyton@peytonpowers.com.
And just so you know, if you're trying to get it pre-approved with a different lender, and the only thing they do is pull your credit, that is not that's not a good lender. A good lender is going to do all of the work up front, so there's no surprises.
We don't like surprises.
Yeah, and that's one of the reasons why I like to work with Peyton. He has been an excellent mortgage broker. He's very customer service driven, and he always returns his phone calls and answers his phone, which is a blessing when you're working with a mortgage lender. So if you have any questions, you can always call me. I can get you in touch with Peyton as well. My phone number is 1-866-589-1646, or you can visit my website at www.lvmodernhomes.com. Stick around. We're going to do one more video on some more mortgage topics. Thanks.